Good afternoon, everyone, and welcome to our very pre-PDAC conference. My name is Joe Fars. I'm a director here in investment banking. We've had a great start to our sessions today, hearing from a number of different battery metal and uranium names, all with a bend on electrification and decarbonization. Certainly an important thematic to us here at Red Cloud, as well as our investors watching. I'd like to highlight that this session is sponsored by our friends over at Pear Tree. Thank you, guys. And for the next 30 minutes, we'll be hearing from one of the most formidable analysts in the space, Mr. Andrew Leland, Head of Strategy at Benchmark Mineral Intelligence. And he'll walk us through his views on some of the many opportunities and hurdles within the sector. As we know, there are many. And I think guys watching know the deal. There's a Q&A function on the corner of our screens. And without further ado, Andy, please take it away.
Thanks, Joe, and thanks to Red Cloud for the opportunity to speak. As Joe mentioned, what I'll do over the next 20 minutes or so is just talk through the sort of background and context to what we're seeing in the battery raw material markets at the moment, how the rollout of the supply chain is going, and some of the issues and bottlenecks that we're seeing in the industry that could ultimately affect how many mines that need to come to market and what prices they're achieving for their products. So for those of you not familiar with Benchmark Mineral Intelligence, we are a specialist independent lithium-ion supply chain research and consultancy. We're also an ASCO certified price reporting agency. So that means as part of that price reporting process, we collect and collate a lot of the lithium hydroxide, carbonate, cobalt hydroxide, graphite, etc. prices, which are used in contracts in the lithium-ion supply chain. And that's really important because what actually happens in this supply chain is you have the producers who work in markets with extreme price volatility, as you're well aware of, and then they sell that material to a cathode producer or an anode producer who sell it to a cell manufacturer who sell it to an automotive company. But that middle stage of the supply chain doesn't take on the price volatility. So they can't pass that cost through. So when you're looking at things like price volatility in these markets and the huge run-ups that we're seeing in lithium prices, that is really an issue between the producers and the ultimate consumers. The lithium price doubles, Tesla, GM, Ford, VW, they're the ones who have to take on that price risk. And as we see as we go through the presentation, that's really important as to how this industry is developing and indeed where financing and offtake contracts are likely to come from in the future of the industry. Benchmark itself also has a range of subscription products and consultancy services. I won't go into those in detail here, but if you want more information about the company, feel free to scan the QR code that will also pop up at the end of the presentation. So what does battery demand look like today? You can see here on the left-hand side, we've got the split between the total market, about 400 gigawatt hours of batteries consumed last year, of which almost 300 were already going into the transportation sector. If you look around you, you've probably got lithium-ion batteries on your laptop, in your phone, maybe on the watch on your wrist. And you can see that market is already not quite minuscule, but it's a lot lower than the size of the challenge from electrification of transportation. And obviously the outlook is to see huge growth. The little yellow bar there in the middle is energy storage. These are, industrial scale batteries which are used to harness and store renewable energy, or also to regulate grids and in frequency auctions in that sector. A little bit less certainty about demand forecast there because they do potentially have other battery technologies they could use in the future. But you can see here the sort of breakdown as to where batteries are going at the moment. When we look at the demand profile for batteries, it's pretty aggressive. It's a very strong upward curve, and you can see there the role that transportation plays in this sector is absolutely crucial. It's also crucial because when somebody's setting up this supply chain, you don't have necessarily liquid markets. They're not really commodity markets where you can sell material anywhere. You need to be able to have a sort of take or pay offtake contract, and also to have qualified material. So what that does is it puts the automotive producers quite often in quite a strong purchasing power perspective when they're dealing with the supply chain. Again, that will impact a little bit later in the presentation. How confident are we of this strong growth within the market? Well, actually more confident than you would be in most other industries. I've been a metals and mining analyst for 20 years now, and certainly I've never come across a demand profile that is as strong as this industry is. Even throughout the commodity super cycle, obviously that impacted more commodities, but it didn't impact them to the degree that markets like nickel, cobalt, lithium, some of the more specialty chemicals, also the graphite anode chemicals, are being impacted here. And that's because this move in the energy transition stems from a political mandate. So you actually have a government-driven remit to move towards zero emissions vehicles, which lithium ion is by far the winning technology. That's then supported by investment from the automotive companies, because they've been told they have to end internal combustion and they can't afford to maintain two supply chains indefinitely. We would then see all the announcements in cell capacity, which is the type of thing that Benchmark track on a regular basis. And then also we see the impact on the raw materials as well. And as I say, that stems not just from a consumer choice, but also a political mandate. So this demand profile actually has a huge amount of certainty to it. Building out the lithium supply chain involves building out more than one sector. You can't just build a mine and not have a product. You can't just build an electric vehicle and not have a supply chain. And what this means is you've got these sort of 6 main pillars of this supply chain that basically all need to be built at once and to align with each other as to when they come to market, which is very difficult to do. We're dealing with companies all over the world based on geology, with industries which are very different to mining when you're talking about, say, automotive production or cell manufacturing. So that alignment between the extraction, the chemical processing, cathode and anode manufacture, the cell manufacturing, the application and recycling is something that the industry is struggling with. And if they're not all aligned, then you get bottlenecks. So at the moment, where do we see bottlenecks in this industry? Well, we see it at the cell manufacturing side, which is impacting the amount of electric vehicles that can be produced. The biggest constraint on the overall rate of electric vehicle penetration in the industry is not down to consumers not wanting to buy electric vehicles or range or charging anxiety. It is supply of electric vehicles. The more that Tesla can make, the more that they can sell. Pardon me. And that's the case with many other companies as well. So they have a bit of a shortage of cell manufacturing. That will ease over the coming years. Generally, cathode and anode production is keeping pace with the industry, although as we'll see on the next slide, there are some geographical limitations which are impacting the supply chain. Chemical processing, typically these units can be put up relatively quickly, but then you get to extraction of raw materials. And this is where bottlenecks can really bite, because you can't bring a mine to market in 1 to 2 years. And that can mean that when you do get situations like we're seeing in lithium, we'll look at the lithium price in a moment, you do get sustained high prices and very high equity valuations for a period of time. Pardon me, it's not COVID, I promise. So when I speak about the sort of geographical limitations, this data is from the end of 2020, but it hasn't changed much. You can see that China's really sort of stolen a march here. I don't think there's anything malicious to that. They just sort of, had a plan to do this and have enacted it and have been very successful in that. But the percentages are incredibly high, and they're also not politically acceptable to politicians or indeed to businesses to have that level of control in any one country for the major automotive supply chain. If those percentages stay the same, it would mean tens of thousands of job losses in places like Canada, the Midwest, Germany, which traditionally produce automotive components at the moment for internal combustion, and replacing those with jobs in China. And that would be stemming from a political mandate. So that's obviously not very popular. And what we're seeing is huge amounts of government activity now to try and move as much of this supply chain, the middle stage of that supply chain, to support the raw materials that Europe and North America are sort of blessed with, particularly Canada, and line all of that up. And a good example here, you can see the announcements that we've had in the USA just over the past year. You've had a doubling of the amount of gigafactories which have been announced in North America. You've seen a lot of people charging to give out subsidies to try and promote where these industries can come from. We've recently provided some advice to the government of Ontario as well, looking at how that they can attract more of this investment to that part of the supply chain. And the real sort of key here is that when I mentioned those take or pay contracts, ultimately the owner of that contract is the automotive company. And they're the ones that will control how many cells they buy, which controls how many cell manufacturers they are, which controls how many cathode producers there are, which control how many chemical refineries you need, which ultimately controls the demand for the raw materials. And that's why you're seeing a lot of the automotive manufacturers get more involved with purchasing of raw materials directly. And it's not an industry that historically they wanted to be involved in or wanted to understand. It's very different to the automotive industry in terms of how it values risk, and they're just about getting their heads around it. And ultimately they're having to plan a lot more for encouraging demand and offtakes to encourage all of this new supply to the market. A lot of the money that you see, which is very happy to invest in the energy transition, is looking for green projects to invest in, will invest in these cell projects at the drop of a hat. And we're seeing more and more, sovereign wealth funds and government funds being diverted from the hydrocarbon sector into this sector. But quite often that money is given a remit to invest in renewables. And the issue there is that there is quite this philosophical block as to whether they should be investing in extractive industries. When you think of making investments in the energy transition, you don't think about cobalt mines in cobalt mines in the DRC or lithium in Latin America. So we are seeing some capital shortfalls which are seriously impacting the industry. This is a sort of little map of what I guess a typical supply chain looks like now for North America. A lot of the components are now being built out on raw materials, chemical processing, etc. But typically at the moment, they're very global supply chains. They're global supply chains that are going to move to regional supply chains. So what we see is you have resources based around the world, and then invariably they're sent to China, Japan, South Korea. They are processed, and then they are sent to a cell manufacturing facility, the majority of which are in China. But we say we have cell manufacturing now in the US, potentially in the future in Canada as well, and then that goes to the car. What people are trying to do is move as many of those dots to Europe and as many of those dots as possible to North America. And what you'll be aware of is that Canada in particular has the majority of the raw materials that are required to go into this supply chain. What we don't have at the moment is that sort of missing link, as I say here, which is the cathode and the anode facilities. So if you're producing a lithium hydroxide or a nickel sulfate or a cobalt sulfate at the moment in North America, you can't sell it there. You need to send it to South Korea to be processed into a cathode, and then you need to send it back to go into the cell plant. So there is this sort of missing link in cathode and anode processing, which I know both governments north and south of the border are actively trying to encourage. So something worth bearing in mind there, that it's another disconnect in this supply chain between where all of these stages are being built out geographically. But ultimately what we're going to see is all of that investment happening on a much more regional basis. It makes sense from a shipping perspective, from an environmental perspective, from a working capital perspective, from a job creation perspective. It is a change that's going to happen. These are investments that are going to happen, which will lead to more raw material demand. But it takes time. And as I say, there are a lot of disconnects. What does a disconnect look like? It looks like this price chart, right? You go back to 2015 and there were sort of 16 lithium producing assets anywhere in the world. You get to 2020, there were 32. Market was an oversupply. You can see prices declining there to below $10,000 per ton. Very few investment decisions were made, and that set us up for the phenomenal price rises we saw since the beginning of 2021. It's a story as old as commodity markets. The issue is now you're in a period of very extreme tightness, and those spot market prices in China, which are the blue and the yellow line, there's actually very little material traded on spot, partly because there isn't availability at the moment. So, most people aren't actually seeing those prices unless they're ordering batteries right now. But those prices are probably closer to 70 or 80,000 at the moment. Most lithium going into your supply chains would be closer to 35,000. But eventually, unless those spot prices come down, they will follow them higher. And as you can see from the text there, that's potentially adding, depending on the size of the battery, $1,000 or $2,000 to the cost of every electric vehicle with a reasonable pack size. And actually, when you consider all of the cost inflation that's happening elsewhere in the supply chain, I wouldn't be surprised if you're seeing $3,000 or $4,000 added onto the cost of an average electric vehicle, primarily because of raw material commodity price inflation. This is something that Benchmark's been warning about for years. We've testified to the US Senate on this several times. You look at our social media, it's all over there. And it's something, the industry, unfortunately didn't really plan for. There were lots of projections out there that battery prices would continue to decline forever, purely because, they've been declining in the past. And that was wrong because it underestimated the role that commodity markets play and the role that cost pass-through mechanism plays. So we're in a situation now that, the price of electric vehicles is increasing. People have to produce them. At the same time, electric vehicles are getting cheaper. Now, they're not getting cheaper because they're getting cheaper to produce. They're getting cheaper because you're moving from a premium product, your Tesla Model S, $100,000 vehicle that can probably absorb that kind of price rise, to a mass market vehicle, the Model 3, with a starting sticker price around about 35,000 US. You can't absorb that kind of price increase. So, what that's doing is, again, focusing the automotive company's mind to invest in this space because they need the material. They need it to have some price stability. And, it's really quite an exciting time for these industries which are impacted there. Just to go back to this slide, this just shows some of the major industries that are impacted by the growth in this supply chain and how many of them are sort of, battery markets versus markets which have battery demand. Lithium, as you can see, the yellow is the growth in the battery side of the business, very much driven by battery growth. Natural flake graphite, very much driven by the battery market. Cobalt, pretty much the same. Nickel, very different situation because you're going from a small to a large share of the market. But most new developments in nickel are focused on the battery supply chain. Existing assets, you're less likely to see converted. They're more likely to stick with the customers and relationships that they already have. So when you look at the big nickel producers in Canada, realistically, they're probably going to stick with their own supply chains. And to be honest, they can't get premiums for that. Why would they spend more money to make less? But again, it opens up the industry to a huge amount of potential in nickel, cobalt, graphite, and lithium operations. So the final slide from me before we open it up to Q&A is this one. It's a piece of analysis that we did looking at all those different stages of the supply chain and where the biggest bottleneck risks were. So we looked at a lot of things here. Is there a liquid exchange market where you can hedge price risk? Yes, there is in nickel, but not really in any of the others. A lot of people are trying to develop that in lithium and cobalt, but there's not really a huge amount of liquidity yet. The next column is looking at company control. Is there any potential for monopoly power? And certainly on this particular index, which the US DOJ and the European Union use, there's no real industry consolidation from a company perspective, or monopoly or oligopoly power. So those industries will continue to be very much determined by market pricing. Then look at, is there country potential monopolies? And yes, there is. Obviously you've got things like the DRC in mined cobalt, but also, China in refined cobalt, China in anode, China in cathode, China in lithium batteries, China in, all of those China. So other than the DRC one. And then we look at, is there a structural deficit in the market? And do you have time to fill that structural deficit? Because it takes a long time to bring the raw materials to market. And I guess the sort of key takeaway from that is lithium is the biggest challenge. Lithium is driven by the battery market. It's already seeing shortages. You can't turn the taps on immediately. There's no above ground stocks. There's no exchange. There's no competitor market that you can steal units from by paying more. You might actually get to a point where you run out, and then you get to demand destruction, which is where effectively, you get to a situation like the semiconductor shortage at the moment, that you simply won't have lithium units, no matter how much you can pay, to produce vehicles, which means the whole of the rest of the supply chain, as we've seen with semiconductors, comes to a stop. So lots of issues with the supply chain itself building out, also lots of opportunities with that. So that's it from me. Hopefully that sort of piqued your interest in the supply chain, and given a bit of background for the Q&A. And as I say, if you'd like to learn more about Benchmark, feel free to scan that QR code. Joe, over to you.
That was great, Andy. Really appreciate the overview there, and really speaking to some of the opportunities and as you mentioned, some of the hurdles that we need to get through. And just on that, on some of the hurdles, you did mention the challenge of actually selling, carbonate or hydroxide within North America, as it pertains to the cathode supply chain. What do you think are the next necessary steps to really address that issue?
I mean, in some respects, they are being addressed. So you're starting to see a lot more companies thinking about putting cathode facilities up in North America. And there are two ways you can look at that. Do you build that off the back of raw material supply, or do you build it off the back of having automotive manufacturing and cell capacity? So just look at it this way: if you're in Quebec, you're doing it from the raw materials. If you're in Ontario, you're doing it from the automotive industry. And we will certainly see a lot of announcements being made of new investments in the cathode space to close that gap in the supply chain. One of the other barriers that's worth mentioning is intellectual property. It's a big issue. That's where intellectual property really is a bit of a barrier to entry for the cathode, because that's what helps determine the energy density of the cell and therefore the range of the vehicle. That's very much dominated by Japanese, South Korean, and Chinese companies. So what you'll see is, it will be companies like that, not necessarily homegrown companies, that are being encouraged to invest. The same way, if you look at, cell producers in the US, the big ones are LG, Samsung, SK Innovation, Panasonic. It's going to be sort of, different names, but not dissimilar when it comes to the cathode and also the anode side.
Yeah, it seems like there's been some improvement for sure. Your slide 7, I think, really highlights that as to how many more plants have been being developed. Just looking at that seemed more geared towards cathode capacity and building on gigafactories. Are you seeing anything in the way of conversion ability in terms of accommodating, hard rock or spodumene or potentially claystone and then converting it there out, or is it still, the process of getting through to through other avenues, overseas, and then obviously being brought back in?
I think the majority of North American projects are looking to co-locate or near locate their own conversion capacity. So the industry in North America is going to develop as both a mining or pumping and conversion to chemical facilities, because that's the product that's demanded. Whereas that's very different to how the industry developed in Australia, where they mined spodumene and shipped it all to China, and are only now putting in the chemical conversion facilities. And that's because the whole reason of putting these assets into North America is to supply a North American supply chain and have that regional supply chain, job creation, transparency, etc.
Yeah, changing gears a little bit. One of the things you mentioned was the fact that EVs aren't necessarily getting more expensive because of this, mass scale and an economy of scale that's being offered. Do you expect that to change at all in the event that we, approach a super cycle of green energy metals here, and we start to see commodity pricing really rally? I mean, lithium prices have skyrocketed here. Do you foresee that impacting EV prices at all, or the fact that the pricing themselves of these raw materials don't really impact an EV cost overall?
So an electric vehicle is a substitute product, right? If you go out, you can either buy an internal combustion or an electric vehicle, and the price points are relatively similar, and they're well established. So they're trying to fit that supply chain into well established pricing points. Commercial vehicles, people will put a financial model together, and they'll look at the value of that vehicle over time, and they'll look at the energy cost, etc. I don't know what your car buying habits are, Joe, but I tend to buy the nicest one I can afford. The OEMs are limited as to how much they can pass through. But they're going to have to pass some of it through, particularly with the lower the lower sort of margins that they make on mass market vehicles. But some of it will come down to governments continuing to have to subsidize an industry, and then eventually you get to the cutoff where you have to buy an electric vehicle, and then I think inflation is going to be a major issue, and one of the trends of this decade is we know it's going to be inflation, but in particular it's going to be inflation in energy transition industries, and with that the mining industry is actually one of them.
Right. Yes, I definitely see inflation having an impact on everything here. As an EV buff, I'm also bullish on oil and gas, just given the fact that as one becomes expensive, the other becomes much more accommodating, and I think that there will be an impact across this space without question. Another question here is related to just disrupting tech. Do you see any future technologies that are really disrupting the square? I mean, we've talked about solid state batteries in the past. What's your view on how that impacts lithium specifically?
So the main benefit that lithium has is it allows you to have very high energy density cells. And when you're looking at the transportation sector and you need things to be light, and you're working in the constraints of the size of a parking space, you can't change all the size of vehicles to put in a different technology with less energy density. Energy density is key. And lithium at the premium end of the market is really the only game in town when you're looking at long range vehicles, which is the majority of the models which will be rolled out in North America and Europe, because range anxiety and charging anxiety is still something. People typically want a vehicle that will do 300 to 350 miles, and to do that you need these high nickel chemistry lithium ion batteries. Where you do get demand destruction is potentially, say, in the energy storage sector, and also potentially in the lower range vehicles. So that's what we call an LFP cathode at the moment, lithium iron phosphate. That's sort of the entry model vehicles. You take about a 40% energy density hit when you move to an LFP cathode. And what we're seeing at the moment is this new technology called sodium ion is coming in with performances which is not dissimilar to LFP. Now, you're a couple of years away from that really coming to market. It takes a long time to qualify these materials. But yeah, you'll see a little bit of disruption there. But you're not going to see overnight. You may read in a newspaper article or a journal that this new technology has been established and it's going to revolutionize everything. It's not. There's very little out there which is going to hugely disrupt this. And if it was, it would take at least 7 years to massively disrupt the market.
Agreed. Yeah, I think the NMC chemistry is here to stay, and we've certainly seen its impact on what is certainly sought after from a lot of the OEMs already. So with that, we're out of time, and Andy, I do appreciate you keynoting for us today, and we appreciate the BMI sponsorship as well. I would encourage everybody to stay tuned as I turn it over to my colleague Dave Talbot, who'll be tackling the uranium space with Anna from UXC. So thanks, everybody.